Business organizations, the short swing rule, restricting insiders making short swing profits from inside information. The short swing rule, a federal rule enforced by the SEC, requires company insiders to return any profits made from the purchase and sale of company stock if both transactions occur within a 6-month period. The idea is to prevent insiders from taking advantage of non-public information. The profits are disgorged and paid to the company. The objective standard of Section 16 applies strict liability regardless of the intent of the insider or the existence of actual speculation. As the officers are unlikely to have the company bring the suit against themselves, this is often a derivative suit brought by shareholders wishing to recover short swing profits made by officers. The short swing rule applies to publicly traded companies listed on national stock markets with more than 500 shareholders and more than $10 million in assets. As with many SEC rules, federal jurisdiction can be triggered by use of the telephone, mail, or any instrumentality of interstate commerce. What constitutes an insider for purposes of this rule is defined in the statute as any officer, director, or holder of more than 10% of the class of shares traded. These statutory insiders must report all trades to the SEC. So the elements of a short swing rule comprise profits from trading securities within a 6-month period, a statutory insider of a publicly traded company with more than $10 million in assets. Although this is a strict liability rule, some trades can escape liability. An individual qualifying as a statutory insider at the time the shares were sold, but not at the time the shares were purchased, avoids liability under the rule. This usually applies to individuals promoted to officer positions in the organization after they've purchased the shares sold. Likewise, a shareholder holding more than 10% of the shares at the time the shares were sold, but not at the time the shares were purchased, is not considered a statutory insider. The shareholding must exceed 10% at the purchase as well as the sale. An individual with a senior title like vice president, but no access to insider information, is not considered a real corporate officer and can escape liability for short swing trades. Mergers can mandate the transfer of shares. The sale of shares under a merger with no potential for speculative trading will escape liability under the short swing rule. The rule is intended to address voluntary, speculative trading, not the involuntary sale of shares as the result of a merger.